So in today's video, we're going to go over what the Federal Reserve actually said yesterday and what really caused these to jump up the way they did. So if you're out there looking to buy or refinance, hopefully I can help you out in today's video, folks, because my name is Dan Frio. I'm a mortgage advisor, and I'm here to explain to you guys what in the heck's happening with those and the whys behind it. So here's what we had yesterday. We had the Fed coming in and they cut rates. Okay, that wasn't the shock. We knew the Federal Reserve was going to cut rates. But then what they said afterwards was this. They said, we're going to come in and we're going to announce quantitative tightening. Now, they said this last time. But then what they said is it's going to start December 1st. But what we're going to do with the money was the concern that the investors had. So here's what happens. Usually when you have bonds paying off, so let's say, for example, a bond matured, or it's a mortgage bond. So somebody paid off their mortgage, refinance or whatever. So that money gets put back into the bond market. Okay, so the bond matures, money's available. And usually what happens is the Federal Reserve, when they get that money, they'll roll it back into the bond market. Okay, so what they announced yesterday is they're going to roll it back, but in short-term maturities. So 2-year treasuries or 2-year treasury bills, they're not going to buy mortgage-backed securities and long-term treasuries. Now, this is going to put some strain on the demand for treasuries. What's going to happen there? Well, if you have less demand for something, it's going to have to bring down the price of that product or whatever it is, and to find a buyer. Well, what do we know in the bond market? Well, let's get over to it. Here's what happened yesterday. So it's going to continue today. So when we had the announcement yesterday, here's what happened when the Federal Reserve said, okay, we're going to do quantitative tightening, but we're going to roll that money into short-term bills. And that freaked the market. And I didn't get it at first. When I was doing my research last night, it finally clicked. So here's what they're doing. They're going to buy Treasury bills. They're not going to buy any more of these or the long end of the bond. Mainly what this means is the prices of these are going to go down. What do we know in the bond market when prices go down? If you don't know, here's the key word. They go up. They go in the opposite direction. So if the price of bond goes down, which we saw yesterday, that's what happened with this. So it wasn't what the Federal Reserve came in saying anything about interest rates. It's basically they said, we're going to quantitative tight. We're going to start December 1st. And what we're going to do with the money is what really shocked the markets. So let's get over and see how the reactions are going today. But this is going to be pretty difficult.